I think it comes back to who are you as an investor? What makes sense to you? Have a discipline. That's an important word. You know why you own that stock. The pressure from the crowd, if you've not done your homework, can really overwhelm and scare you into or out of a position.
What still works and what doesn't? Part 2 of our interview with Bob Doll is on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. As Wealth Track looks back on our 20-year history, we are asking some of our earliest guests to join us to share their observations on how the investing world has changed since they first appeared, and most importantly, how being a successful investor has changed. One of our first guests was Robert Doll, then the President and Chief Investment Officer of Merrill Lynch Investment Managers. Now, Doll not only ran the business and strategy, he also managed large-cap U.S. equity portfolios, a practice he continues to this day. Doll is also well known for his long-running list of 10 annual predictions, forecasting market, economic, interest rate, and political trends, among others. Since Merrill, Doll has held similar positions at BlackRock, Nuveen, and now Crossmark Global Investments, a faith-based investment manager, where he is CEO, Chief Investment Officer, and once again portfolio manager of 3 different large-cap strategies: large-cap core, value, and growth. The only difference is that at Crossmark, in addition to using traditional fundamental and quantitative analysis, he can use Crossmark's values-based screening. I asked Doll to reflect on the last 20 years. What are the most impactful changes that have occurred in the financial markets?
Oh, Consuelo, there have been so many changes that all of them are gradual. So you wake up and you say, oh, look what happened. For example, I remember the first job I had as a research analyst at Citibank. If you wanted to know what your stock was doing, you went up to the one Bunker Ramo machine that was sitting on the table, and you got in line and you came in, was your turn, you punched in your stock, if you can believe it.
I do believe it. I remember that myself.
Remember that?
Yeah.
Of course, now it's on our phones, it's everywhere. So that is a big change. I can't wait when the technology comes out that shows me what's going to happen to tomorrow's stock market today. So that's a big change. I would say also, while we're dealing with information, access to information. In the early days, I remember it mattered. Did you get the first call from Wall Street, or were you the 5th call or the 15th call? So that mattered. And so you always wanted to be just ready to get the information. Now everybody gets it instantaneously.
Right, at the same time.
That's a change at the same time. So the edge isn't relationships and where you are in the pecking order. It's being smart about how you analyze companies and instantaneous information. So I have information, I got to trade now. Doesn't exist much anymore. It's more, let me figure it out over the long term. I think what's also changed noticeably is the number of stocks out there. I wrote down here the Wilshire 5000. For folks unfamiliar with that, that's the largest 5,000 stocks. Well, at the moment, there are only 3,400 stocks in the Wilshire 5000. Repeat, 3,400. In 1998, there were 7,100. It's only 5,000 counted. Now, where did those several thousand companies go? You know, they went into private equity. They left the public market. So we have fewer stocks to deal with. Price levels. You know, it used to be when a stock got to be $50 or $100, you know, they'll do a 2-for-1, a 3-for-1, a 4-for-1 split. Now it's almost who can have the highest stock price. So that's a big change also, making it tough for individual investors to own some of these high-priced stocks. Yeah, I can own 1 share, whereas we used to buy 100-share round lots. So that's another big change in the market. What I would say also is when you trade, the market is, you know, New York Stock Exchange is open from 9:30 to 4 o'clock. You had a trade between 9:30 and 4. Well, now you can trade round the clock. Sometimes the liquidity issues outside of the opening hours, but you don't have to wait for 9:30 in the morning to sell or buy your stock. You can do it anytime. So you see these things. I guess a darker one that I'd have to point out is regulation and having to fill out forms. In my early days, the mutual fund industry, for example, was a cottage industry, and it was kind of left alone because we weren't big enough to matter. Now, the amount of time we all spend, Consuelo, filling out forms, adhering to regulations, listening to compliance officers, that's really changed a whole bunch. So these are some of the highlighted changes. I still say, as you and I were kidding before, it still beats working for a living. It's just amazing. You can come and do this business. No 2 days are the same. The minute you think you have it figured out, the market smacks you across the face and humbles you. And you get up and you try again. And you learn along the way, but then there are new lessons to learn. And that's the beauty of this business. It never runs out of steam.
So let's unpack some of those big changes because they are major. On the one hand, it's interesting that you've got the democratization of information. I have a friend who is a retired money manager who basically said, I don't need a Bloomberg anymore. He runs his own portfolio. I can just do it by Googling everything. So there are so many more options, tons of information that is available to all of us. So democratization. But on the other hand, as you mentioned, where there used to be 7,000 traded stocks in the U.S., there are now, as you said, the Wilshire 5,000 is now 3,400. So in the, public equity markets, there are actually fewer opportunities to invest. I think that's an interesting contrast.
It is an interesting juxtaposition. 20 years and a few weeks ago, you didn't have this show. You now have it. And so people get information from this show. They listen, they hopefully learn a little something, they try something out. You go back far enough in time, there were no broadcasts of anything.
Right.
Now we have financial television all over the place. So you're absolutely right. And then the other side of it, as you point out, and my guess is that 3,400 is going to continue to shrink. A lot of companies don't need to be public, and therefore they'll go into private space. A lot fewer hangups, a lot fewer regulations. It's a lot simpler in many ways if you don't need access to the capital to participate in growing a business.
And as the number of publicly traded stocks have shrunk, the number of options to invest in stocks have grown just exponentially. And when you think of the ETFs and the sector funds and the factor funds, the market has been sliced and diced in so many different ways. But are there greater opportunities, or is the market more risky for individual investors to invest in, and even you as a professional investor?
Great observation, and I would answer it's both. That is to say, if I'm good at one thing, I should stick to that one thing and let somebody else play with those. So take options, for example, call options, put options, all kinds of maturities and time and price level. I don't go there because somebody's going to eat my lunch, because that's not where I've studied and grown up and tried to establish expertise. But when it comes to creating a large cap U.S. equity portfolio, I'm willing to fight you on that one, because I think I have some clue with a lot of scars along the way. So you're absolutely right. Investors need to know, what are they trying to do? What are they good at? And not be tempted by every new shiny object that comes along the way.
So you mentioned, that the edge that one no longer has, that institutional investors, professional investors used to have, in that the CEO or the CFO of a company would take your call first if you were a big enough client. And now we get access to all of that information. So as far as your job as a portfolio manager, how has your approach changed?
From what you just said, the way it's changed is I don't call my trader and say, buy me 10,000 XYZ, because if I want to buy 10,000 XYZ, it's part of the order for the day. And I say, execute the order during the course of the day, because I no longer have an information edge, which is actually very good. We become really true investors, in a sense, as opposed to where am I on the information hierarchy? When do I get the information? So it's a healthier move.
So where is the edge then, Bob? Most professional investors have underperformed the indexes, their benchmark indexes. I mean, there are a lot of reasons for that. Number one, indexes don't charge any fees. They don't require really any maintenance, whatever. But it's really hard to beat the benchmark. So where is the edge for an active manager?
First, a postscript to your observation. My guess is we're heading into a period where the indexes aren't going to do quite as well. Indexes are dominated by the biggest weights in those indexes, and portfolio managers tend to be more equal weighted than they are capitalization weighted. So when you get the big companies dominating, Magnificent Seven, perfect example, it's really hard to beat the benchmark. If we're moving to an area where interest rates are more normal rather than low, like you said, there are a lot of reasons why the indexes have done so well. I think the average active manager stands a much better chance going forward. Your question was, though, where do you get your edge? Well, that's gonna be different individual to individual. I've over time worked on having a quantitative model, for example, has 55 variables in it. That every day I get updates on those variables, and they help guide me in directions. It's not the answer, but it points me in direction. The weight of the evidence, the stocks that score highly in that quantitative model over time outperform the ones that score poorly. And so there's a good guide. And so it's through research, whether it's quantitative or fundamental or technical, that you try to develop an expertise and win over time. But it takes a lot of years to do that. Very difficult. I still admire the people who, they spend a half hour a week and they'll buy in this stock and selling that stock. I do it for a living, and I still struggle, but I guess I'm probably dumber than the average guy.
I don't think so. But so, for instance, what are the variables? And I remembered for years you have used those quantitative and qualitative assessments in order to buy stocks. You seem to me to have been early in building these quantitative models.
Yeah. So here's
correct me if I'm wrong.
No, you're absolutely right. Here's something
Yeah.
that's changed. I should have mentioned earlier. When I started to build a quantitative model, it was a manual model and it had two variables.
What were the variables? Do you remember?
Yes, I sure do. On the growth side, it was earnings momentum. And on the value side, it was a dividend discount model. And you know what, Consuelo? It worked because the market was much less sophisticated. Time has gone by. The market's gotten a lot more sophisticated. And now we have 55 variables. It's on a pretty fancy computer. And the world has changed and probably will continue to.
So, but what are a couple of the other variables? Are there any variables? I'm asking you almost like a factor. I mean, is it momentum? Is it dividends? Is it are there some variables that are kind of basic variables that you absolutely have to pay attention to?
Yes, and it's all of the above. For example, they fit into categories. One category is valuation. Price to earnings this year, price to earnings next year, price to normalized earnings, price to cash flow, price to revenues, price to book. These are some of the valuation variables. Then there are earnings variables. Is the company's growth rate accelerating, decelerating? How'd they do relative to expectations? All these variables fit into this model. For a variable to fit into our model, it has to make sense, it has to be testable, and it has to add value to what's already there.
Is there any such thing as an investment truism anymore? It used to be, don't fight the tape, don't fight the Fed. I mean, are there any? Are those still valid, number one?
They're absolutely valid, no question about it. The trite and true is buy low, sell high. Although in these markets, people say to me, no, it's buy high and sell higher. And maybe there's some of that going on too. Look, I think patience is something that's important in the market. You might have all the right reasons to buy a stock, and it may go against you for a while. That's the hard time when you have to examine, is my premise still accurate? If so, and the stock's going down, you might want to buy some more. Conversely, you have to be quick to say, the thesis I had isn't happening. I better jettison this stock and move on, whether it's a gain or a loss. I would say also, while taxes matter, when you're buying or selling a stock, do it based on where you think the stock's going from here, not based on what price you bought it. I find a lot of people get into that trap. Oh, I can't sell it because it's a loss, or I can't sell it because I have to pay a capital gain. They're less important reasons, in my view, when you're doing your research and trying to figure out what stocks to own in your portfolio.
How patient can you be as a professional investor?
So the good news about a portfolio is you got a bunch of stocks. So I have some stocks in my portfolio that, I hope are there forever. They just keep cranking it out. The stock never gets so expensive I have to sell it. And other stocks have been in there for a while where, the thesis just hasn't happened, and I have to keep re-examining, keep pinching myself. Is that stock in the portfolio for the right reasons, or am I married to an old idea and I got to get real and move on? So, and I come back to, it's not like you're putting all your eggs in one basket. Or let me say it a different way. Your 10 favorite stocks are not a portfolio. That's a risky portfolio. You need to have portfolio construction, risk management, so that you don't go off the ledge because you inadvertently own one factor that all the names fit into, and that factor goes out of favor, and you got really bad performance.
There used to be, in my grandparents' day, you used to be able to buy a blue chip company, like a Coca-Cola, for instance, a stock that you hold in one of your Steward large cap equity funds, right?
Yes.
And that you could buy a company like that, and you could pretty much depend upon the fact that you could hold it and it would appreciate over time, and also you could reinvest the dividend. And so are there very many companies like that?
Probably fewer than there used to be, because the world changes so fast, Consuelo, and market cycles move around more quickly. So it's probably less than before. But if you can identify a good company with a good product or service, and the phrase they've got a moat around them, such that nobody's going to compete with them for quite some time, those stocks can still work.
When I think about a company that one would think that they would be able to hold for a long time, the name that comes to mind is Boeing. And what has happened to Boeing is it's almost as if a patriotic American company has just fallen on really bad times. Did you ever own Boeing?
Oh, yeah, I own Boeing.
Yeah.
As you know, I manage an equity market neutral fund, which has longs and shorts. And I've been short Boeing, which obviously has made our clients a bunch of money because, as you point out, they're going through the mill, struggling with the planes themselves. Remember those problems. Now struggling with the labor issues. Cash is an issue. So, Boeing's down a bunch, so I don't know if I'd run out and short it here, but you're right. Just because a company was great doesn't mean it'll always be great.
Were you ever long Boeing?
Oh, yeah.
Yeah.
For sure.
So at one point, do you say as an investor, given all the positive about Boeing, that these are short-term problems, or no, this is really these are much longer-term issues, and I'm going to sell it? I mean, how do you reach that determination?
So I remember selling Boeing, not because they anticipated any problems. It just got expensive. Everybody realized what you and I are talking about here, and it was fully in the price. So got to let some go and recognize we don't marry stocks, we rent them. Then, of course, the problems mounted, and I hope I'm smart enough at the right time to cover my short and then watch them turn the thing around and get on board and go long again. Time will tell on that one.
Looking at all of the things that you discussed that have changed in the market, and we're just bombarded with information, and we're also bombarded with the inducements to trade. And one of the things that the classic book, The Intelligent Investor by Benjamin Graham, has just been reissued and updated for its 75th anniversary. And one of the things that Ben Graham had talked about is to be a disciplined investor, and that in order to be a successful investor, that you frequently have to stand alone, that you've got to be independent in thought, that you can't get caught up in the crowd. How much more difficult is it for you as an investor to withstand the pressure of the crowd, to withstand the pressure of investors saying, gee, Bob, why aren't you invested in X?
Yes.
Or, why is, going up? Or, why not Bitcoin? Look at all the minted, Bitcoin billionaires. How much more difficult is it, and how do you withstand that kind of pressure?
So I think it comes back to, who are you as an investor? What works for you? what makes sense to you. Have a discipline. That's an important word. And if the crowd's with you, that's fine. If the crowd's not with you, that's fine. You know why you own that stock. The pressure from the crowd, if you've not done your homework, can really overwhelm and scare you into or out of a position.
So just explain what the discipline is that you have imposed upon yourself. What's the process for a decision to own a stock, to own a share of a business?
So I'll start with it. It doesn't end here, but starts with that quantitative model we referenced earlier. If it's near the top of the model, I better take a serious look, because over time, the top names have outperformed the bottom names. Not all of them, but as a group. And so if it's toward the top, I better seriously think about why I don't own it if I don't. One of the disciplines we have is if I own a stock and I love it, and it moves below the median in the ranking, it has to leave the portfolio. No matter how much we think we like it, it's gone. I call the first quartile buy territory, third and fourth quartile sell territory, and second quartile no man's land. They're the hard ones.
I bet they are. So this is where the quantitative model takes your emotions out of it. Is that right? So that's the
Yes.
discipline that's imposed by the program.
Correct. And as I said earlier, the quantitative model is not the answer. It's a tool. I sometimes use the word, it's a crutch. I couldn't get across the street without my crutch called the quantitative model. It's a starting point for then you to ask a whole bunch of questions. Why does the stock rank highly? Is it likely to stay ranked highly? I mean, a stock might be ranked highly because they've had, 16 quarters in a row of positive earning surprises. But good research says, oh, let me examine that. And if my analyst comes to me and say, next quarter, I think they're going to have a negative surprise, let me tell you why. And we look into that, we might get out of the stock. And boy, you can save yourself a lot of money if you have a few successes like that over time.
Some portfolio managers say that they can have, let's say, 50 stocks that aren't doing well, but if they have like 5 stocks or even 2 stocks that are doing really, really well, that's going to make their performance great.
For me, at least, it's more evenly spaced. I saw from a tennis pro who won so many awards, he calculated how many points he won. He won 53% of the points, he lost 47. Well, my goodness, is that good enough to be have a outstanding all-star career? The answer is yes. It's the same thing in money management. If I can get 53, 54, 55% of my stocks to outperform, my clients will be very happy.
One investment for a long-term diversified portfolio, if we had to own just one thing, what would you have us all own?
I'm going to stick with quality companies that I think have a bit of a moat around them, such that it's going to take a lot to break down the walls. I go, for example, to financial transactions, credit cards. MasterCard at the moment is my favorite. If you own Visa or American Express, that's fine. How about defense? I don't think the world's going to get to be a safer place. So I want to own long-term a Lockheed in my portfolio. And then there's technology. Can't ignore that. There are lots of choices here. I'll go with a hopefully safe one, Apple computer.
Moats. Very important. That's a Ben Graham concept and also a Warren Buffett concept. And thank you for, again, giving us 3
Three to choose from.
choices, 3 to choose from for a one investment. Bob Dahl, thank you so much for being one of our first guests and sharing your reflections of the last 20 years with us on Wealth Track.
You've done a wonderful job over these 20 years. It's a pleasure to be part of it over there. And as I say, this business beats working for a living. There's no heavy lifting, and it's indoor work.
And I get to talk to some wonderful people, you included, Bob Dahl. So
Thank
thanks
you.
so much for joining us.
A privilege.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is consider keeping the U.S. as the core of your stock portfolio. Now, it probably already is, but there are reasons to keep it there. U.S. stocks have been the most profitable and fastest growing in the world since the global financial crisis and most decades before that. Yes, U.S. stocks have outperformed other markets and are therefore historically expensive, but there is a reason for that. They are competitive. They put the interests of the shareholders, their owners, first. U.S. companies are regulated, but not overly so, at least not yet, and the U.S. is still a great place to do business. Foreign diversification has its place on the margins, but unless you are a professional investor able to research markets and companies on the ground, it is difficult to do well on a significant scale. A largely stay-at-home strategy for individual American investors makes sense. Next week, Jason Zweig, the editor of the 75th anniversary edition of The Intelligent Investor, Benjamin Graham's classic, joins us to share the timeless wisdom of what Warren Buffett calls by far the best book on investing ever written. In this week's extra feature, we asked Bob Dahl about his high-pressure job managing both a firm and portfolios. What keeps him motivated? Please follow us on Facebook, X, and our YouTube channel. Thank you for visiting with us. Enjoy your weekend and honor a veteran on Veterans Day. And of course, make the week ahead a healthy, profitable, and productive one.